Welcome to this explainer. Let's be totally honest for a second. Building an accurate budget often feels, well, entirely impossible, right? We spend so much energy obsessing over every single dollar going out. We track the lattes, the streaming subscriptions, the rent. But ironically, we frequently neglect the very foundation of personal finance, exactly what is actually coming in. Because think about it, when you don't know your true income, any budget you build is basically built on sand. So today, we're exploring a highly effective income tracking framework that is absolutely going to change how you look at your money.
I want you to genuinely ask yourself this right now. Do you know how much you actually make? Your immediate thought is probably just to picture your regular paycheck. I mean, we've basically been conditioned to think our biweekly direct deposit represents the entirety of our actual cash flow. But assuming that your primary salary is the whole story, that is a massive mistake.
In fact, research reveals a pretty staggering statistic. Most people underestimate their true income by 10 to 20%. Just pause and think about the sheer scale of that for a second. If you make $50,000 a year, you could be completely blind to $5,000 to $10,000 flowing through your life. You simply cannot manage what you don't accurately measure.
So why does this massive underestimation happen? Well, it happens because it is just so incredibly easy to forget to track our regular, one-off sources of cash. You know, you get a birthday gift from an aunt, you get an expense reimbursement from your boss, you cash out $50 in credit card points, or you make a couple $100 finally selling that old armchair on the internet. Because these aren't steady paychecks, they slip right through traditional tracking methods, and let's face it, we usually spend them just as fast as they arrive.
To capture those lost dollars, we're going to walk through a 5-step framework today. Categorize every income source, understanding gross, net, and timing, choosing your tracking system, calculating key monthly metrics, and finally, avoiding common income pitfalls.
All right, let's dive right into step 1, categorizing every single income source. There are 6 main buckets of income you really need to monitor. First up is active or earned income, so that's your standard salary, wages, and tips. Second, business or self-employment income, capturing freelance gigs and those side hustles. Third is passive income, like dividends or rental properties. Fourth is portfolio income, which includes your capital and crypto gains. Fifth, government benefits, like tax refunds or Social Security. And finally, that 6th bucket, those irregular or one-off sources we just talked about. Every single dollar you receive belongs in one of these distinct categories.
And here is why this matters. Mapping your income into these buckets quickly reveals what financial experts call concentration risk. If you realize you're dangerously relying on just one active job for 90% or more of your livelihood, that is a massive red flag for your financial security. It shows you exactly where you're vulnerable and why you might really want to start cultivating income in those other slices of the pie.
Moving right along to step 2, gross, net, and timing. Okay, here is an absolutely non-negotiable rule of the framework. You must perfectly contrast your gross income against your net income. Gross income is your money before taxes and deductions are taken out, and you track that exclusively for tax planning. Net income, on the other hand, is your actual take-home pay, the actual cash that physically lands in your bank account. Net income is the absolute only number you should be using for your daily cash flow budgeting.
I literally cannot stress this enough. Mixing up gross and net makes you think you have way more spendable cash than you actually do. It's one of the most common, fundamental budgeting errors out there, and it silently kills financial progress. If you build a budget thinking you have your gross income to spend, you are inevitably going to overdraw your accounts because the government always takes their cut before you even see it.
Which leads us perfectly into the timing of your income and the ultimate villain of freelancer budgets: phantom income. This is money you have billed for or earned, but haven't actually received in your account yet. You send out a $5,000 invoice, and you instantly feel rich, right? But until it clears the bank, it's a phantom. This is exactly why personal budgeting must always operate on a cash basis, meaning you record money only when it physically hits your account.
So, step 3, choosing your tracking system. Knowing the rules is great and all, but you need practical systems to actually get this done. Let's compare 3 main methods. First, the simple spreadsheet. You can dedicate one tab per income source with a master summary. It's totally ideal for those of us wanting total manual control. Second, modern apps like YNAB or Copilot. These offer automatic bank syncing, making them absolutely perfect for the automated earner who wants technology to do the heavy lifting. And finally, the manual ledger. Because it intentionally doesn't rely on autosync, it's actually the superior method for waitstaff relying on cash tips or certain gig workers. The key here?
Pick the one that completely removes friction for you.
All right, step 4, calculating your key monthly metrics.
Now you get to put on your CFO hat and run a 4-step monthly checklist. Step 1, calculate your total gross. Step 2, calculate your total net. Step 3, find your percentage breakdown by source. And Step 4, check your month-over-month variance. This last one is incredibly important. Tracking how your income fluctuates from one month to the next is what allows you to anticipate trends and spot downturns way before they ruin your budget.
Now, if you're one of those people whose income swings wildly, say you make $2,000 one month and $8,000 the next, take the average of the last 3 to 6 months. Utilizing this rolling average is the smartest way to smooth out the statistical noise. It gives you a really reliable, conservative baseline for practical, stress-free budgeting without all the whiplash of your highest and lowest earning months.
And finally, step 5, avoiding common income pitfalls. Let's identify 3 sneaky traps that can completely ruin an otherwise perfect income tracker. First up, forgetting annual bonuses or tax refunds in your monthly averages. Letting a $3,000 tax refund artificially spike your monthly average dangerously distorts your true reality for the rest of the year. Second, accidentally counting a reimbursement as real income. Listen, if you buy a work laptop and your company pays you back, that is not fresh income. And third, ignoring in-kind income, like employer-provided health insurance or free housing. Even though it's not cash, ignoring it paints a totally incomplete picture of your true financial position.
I want to leave you with a final provocative thought today. Are you ready to capture your missing 20%? I challenge you to take action and apply this framework to your own finances today. Rigorously categorize your sources, respect the strict boundaries between gross and net, choose a system that actually fits your lifestyle, and calculate those metrics every single month. By doing so, you can finally capture every hidden dollar and take absolute, confident control of your budget. Thanks so much for diving into this explainer with me, and happy tracking!